The White House is hoping to re-inflate the market bubble. President Obama took time at a recent press conference to urge Americans to seize their opportunity at refinancing home mortgages before rates jumped off of their near historic lows. The national average for a 30-year fixed-rate mortgage is at 4.87%, which is up from 4.78% a few weeks ago. The president addressed the issue of mortgage refinancing while surrounded by a group of homeowners whom had already taken the plunge. Major banks and lenders around the country are already facing a wave of new refinancing requests, and the White House believes that refinancing on the new low rates will be helpful for the economy. Unfortunately, there is one glaring problem with the president's logic. This country has already taken the refinancing road. It created the housing bubble, and it played an integral part in bankrupting our economy. Right now, we are looking at some of the lowest rates of the past generation, but the all-time records were set just a few years ago. During the Bush administration, the Federal Reserve dropped key interest rates to the lowest point in decades, encouraging lenders to do the same. Millions of people bought into unfixed mortgages and watched as their monthly rates skyrocketed just months after signing their home loans. During the Obama administration, the Fed has kept its rates even lower than they were during the previous 8 years, encouraging interest rates to drop once again. Even if borrowers have learned from their previous mistake and demand only fixed-rate mortgages, the economy still faces serious problems. And all of this assumes that the bailed-out banks and financiers actually start lending their government funding instead of simply hoarding it. The whole point of refinancing a mortgage is to give the homeowner more money to spend, because less will be spent monthly on mortgage payments. It is possible that a homeowner could use this downturn to get a very good deal on rate reductions. They could then potentially use that extra monthly savings to re-enter the consumer market and start buying again. When coupled with the hundreds of billions in stimulus checks being doled out, a boom in refinancing could potentially boost domestic spending. The problem is that the spending would not really help our economy. For the first time in years, the U.S. witnessed a large drop in its monthly trade deficit from January to February, though it was still a net loss of $26 billion. This was not because America's trade policy was strengthened. It was because the recession is so bad that no one can afford anything, not even cheap foreign goods. If we start putting more money in people's pockets, but fail to address the fact that they are still spending nearly 2/3 of that money overseas, we will not solve the problem. We will simply make it worse. As it currently stands, over half of the money spent in this country leaves our market. It stimulates the economies of Europe, Japan, China, Mexico, and others, but not the United States. President Obama is hoping to continue the policies of the past 30 years by giving people a false sense of security. So long as our consumption is dominated by production from abroad, no amount of economic stimulus or increase in income will help this economy. So long as our consumption is dominated by overseas producers, there can be no recovery. We will simply lose more and more money. Instead of calling on people to refinance so they can go back out to the shopping centers and malls of America, the president should call on people to refinance so they can use that extra money to invest in American companies which employ American workers. The government could set a strong example by doing the same instead of bailing out corrupt and insolvent financial firms. On behalf of concerned citizens, I'm Craig Harrington. For more on this and other related topics, please log on to economyincrisis.org.
Wake up, America! Open up your eyes! Wake up, America! Wake up!
Produced by economyincrisis.org.